It's time to define a marketing term. Commodity broker, analyst, and author of Mastering the Grain Markets, Elaine Kub, joins us. She believes the key to profitable grain trading is building knowledge about the fundamental practices of the industry. Today, she helps us define the word carry. Here's one definition. Carrying charge is the cost of owning and storing a commodity during a period of time. The cost influences the difference between the futures price and the expected futures spot price.
Carry can also be thought of as the futures spreads throughout time, but they don't have to be future spreads. It could be in the cash market. Carry is the difference between the price now and the price later. Let's call it that way. So ordinarily, the price later will be higher than the price now because the grain markets tend to reimburse people who own grain and who store grain. They reimburse them those storage costs to keep an ample amount of grain or our inventories of grain from all flooding the market all at once. So there's built-in motivation usually for people to store grain because they will receive a slightly higher price for it later. That's carry.
And then how do you use carry when you couple it with another term, forward time frame?
Yeah, so all right, let's say you've got grain in a bin right now, and let's say there was carry in the market, because this has been a number of odd years. Right now, the corn market and the soybean market in particular, is inverted, which is the opposite of carry, which means that actually forward prices are lower than the prices that we see right now. But ordinarily, let's pretend that we are in an ordinary situation where there is carry in the markets and there's motivations to store it. How do you know how long to store it? That's where carry comes in, is when you're calculating which forward time frame to use or which to plan on selling. And the way you do that is you figure out what does it really cost you to store grain for a month. And if the cash prices that you will receive 3 months from now do at least reimburse you for storing it those 3 months, or preferably pay you more than storing it for those 3 months, pay you a good chunk of that, what it actually costs you, then that's when you decide to capture that carry and hold on to it for that time frame.
And the cost would include the storage cost, or what you might be paying the elevator to store, what you might be paying yourself if you have your own bin to store, and would include a time or interest payment as well on the money.
Exactly. You're right. If farmers are paying a specific storage rate per month to an elevator, then that's very easy to know. They're charging you 6 months a month. If you're an elevator, or if you yourself are storing this in bins, then yeah, you have to sit down and figure out what are your physical costs. What do you have to pay everybody to do this? Your insurance costs, like you say, the interest costs of deferring that income for a few months. That is a sort of hidden cost, but it certainly is calculated in. Particularly the big grain companies that are storing billions and billions of bushels. This adds up. Little bits and pieces of carry add up, and that's how they make a majority of their profits most years.
That's commodity broker, analyst, and author of Mastering the Grain Markets, Elaine Kub. Today, she helped us define the word carry. A carrying charge, again, is the cost of owning and storing a commodity during a period of time. The cost influences the difference between the futures price and the expected spot month futures price. For University of Illinois Extension, I'm Todd Gleason.